These times are rough for the euro. Aside from the steady declines in the currency's value, the debt crisis that the Eurozone is currently experiencing has given critics another reason to do some euro bashing. Some economists and market analysts have chosen to blame the European Monetary Union and the euro for causing or aggravating the crisis in the Eurozone. Others also believe that countries such as Greece would have had the chance to avoid a crisis if they had control over their own currencies. However, that perspective is somewhat too simplistic. Nations which have their own currencies and full responsibility for their monetary policies also face debt crises with unfortunate frequency. On the other hand, it is also impossible to isolate the problems of Europe from its experimental monetary union. With this, it's important to ask, should the euro be blamed for the ongoing crisis in the Eurozone? In this talk, we are going to look at the issue from different perspectives. There is one way by which I think the euro actually played a part in the current economic crisis. A country such as Greece wouldn't have been able to accumulate so much debt if it wasn't a member of the Eurozone. Because Greece was involved in the monetary union and was associated with stronger economies, investors mistakenly believed that Greek bonds were safe investments, thus allowing Greece to fuel its profligate spending at a low cost. If the country was on its own, investors wouldn't hand over so much cash, or would at least ask for a higher yield. With Greece's mountain of fiscal problems, it's not impossible for the country to get itself into trouble, regardless of the currency that it's using. However, the euro certainly played a key role in the growth of the country's debt to outrageous levels. Now that Europe is in a debt crisis, it appears like the euro is making things much more complicated. Imagine if Greece got into a debt problem and wasn't a euro nation. I think it's safe to assume that the problem could have been easily contained. The Greek economic crisis became a Europe crisis because of the common use of the euro currency. Being a part of the Eurozone makes it more difficult for the debt-stricken European countries to disentangle themselves in the crisis. The euro prevents the governments of the PIIGS nations, Portugal, Ireland, Italy, Greece, and Spain, from implementing the standard policy of devaluing their currencies to become more competitive and ultimately solve their debt problems. Because of the euro, the PIIGS nations do not have a choice but to accept structural reforms and difficult fiscal adjustments. There is another way of looking at this issue, though. One may argue that the problem is not the euro itself, but the management of the monetary union. For instance, if Greece hadn't gone above the debt and budget deficit gaps of the Eurozone, none of this would have happened. Moreover, we can also consider that part of the problem with the management of the monetary union lies in the flaws of the overall Eurozone policy. Monetary policy within the zone has been implemented effectively and working well for competitive countries, leaving weaker nations to suffer with a currency value at which they aren't as competitive. In a zone with a highly varied group of economies, it's almost improbable to arrive at a single policy that will be appropriate for all. With the European Central Bank's fear of inflation, the central bank became reluctant to use its power to aid the struggling countries in the Eurozone. The ECB has also hesitantly participated in efforts aimed to alleviate the ongoing crisis. Furthermore, the monetary union does not actually have a real mechanism that will support the weaker member countries who might be hurt by policies designed for the whole Eurozone. Yet another way to view the relationship between Europe's debt crisis and the euro is that there isn't any. In this perspective, the economic problems of a country such as Greece are self-made. These woes may be the result of mismanagement, ineffective labor markets, and other structural faults that require core reforms. It doesn't matter what currency a country is using. Even if Greece has its own currency, devaluing it may not solve the problem because the Greek economy is just not that competitive to produce much that the world wants to purchase. Looking at this issue in various perspectives, one cannot totally absolve the euro and the way the monetary union is managed from some blame for the ongoing crisis. But it's also unfair to over-elaborate the role of the euro in Europe's current economic woes. Let's admit it, some European countries are very poorly run, and if they were just managed properly, Europe wouldn't be experiencing a crisis today. At the end of the day, countries have to take responsibility for themselves. Furthermore, it's important not to forget that the euro is not an economic tool per se. The euro and European Union were established with the aim to bind countries together to promote stability and peace within Europe. Since the creation of the EU, Europe has lived in the unparalleled period of peace. From this view, the euro has been a definite success. With MXTrade reviews, you can get the latest news updates in the stock market. Sign up a live account with MXTrade now and start trading online with the help of professional brokers and financial experts. www.mxtrade.com